Canada's economy is on pace to match the best annual growth performance since the financial crisis this year, with real GDP growth likely topping 3%. That's up from a little better than 1% on average through 2015 and 2016 when the economy was dealing with the fallout from the oil price shock. Consumer spending is solid, fiscal stimulus is providing support, and the worst of the capital spending downturn in the energy sector has passed. By simply removing that big drag, Canada's economic growth has been allowed to run at a much faster pace. That said, though, it's becoming quite clear that peak economic growth in Canada is behind us, and after topping 4% in the second quarter, we're expecting the economy to settle down into the 2 to 2.5% range through 2018. Now, we all saw the Bank of Canada raise interest rates in back-to-back meetings in July and September, but downshifting growth and still subdued wage and inflation trends suggest that the bank will take a more gradual approach from here, likely resuming rate hikes in early 2018. That should also create a pretty stable environment for the loonie, with U.S. interest rates rising at a pretty similar pace to those in Canada and oil prices range-bound. Just as important as the national growth trends has been a dramatic shift in where economic growth in this country is coming from. British Columbia and Ontario, and to a lesser extent Quebec, are now driving Canadian economic growth, while the oil-producing provinces have really moved to the back seat. That's a significant change from what we experienced over the past 15 years or so, and a trend that we think is going to continue over the next few years.